Welcome back, YouTube. So today I'm going to give you my breakdown on how I evaluate and how I buy the dip. Now you'll see there's some discrepancies around amongst communities and amongst investors, but I'm going to give you my interpretation of it buying the dip and the strategies that I use. I'm going to use crypto because I'm going to compare it to the stock market and the crypto market, but the percentages are going to be different, but the strategy in itself is going to be the same. So I'm going to do this in three steps. It's really like two, but I'm going to give you three steps that you can use to be effective in this process. And the first one is going to be, I'm going to say, consider your DCA and consider your entry points. The first one I'm going to say is consider your DCA and consider your share or coin count. And this is important because what you don't want to be in a situation is when you're defining a dip or something comes down or it's simply red and you end up chasing the pretty much the price movement of the stock or the crypto and it's down 2% or 5% and you're like, oh my God, that's a dip. This is going to go to the moon. This is my opportunity to increase my coin count here. This is a very ineffective way of increasing your position. Now, yes, long-term coin count, share count, all that matters more. But if you're chasing the price of the coin of the stock, it's going to be a very ineffective way of getting the most coin stocks for your dollars. And this also limits you, and it doesn't give you the options you need if an emergency comes up and you need to take profit or if you're even in the red, because that's also another thing too. Because if you're buying too close to the current price, you're almost always going to be in the red with any fluctuation, with any press, any bad news. It's going to be very difficult for you to exit that position if in the event of an emergency, or to give yourself the option to average down. You're going to need something more substantial because every rally you're averaging up. So you just kind of got to be, which is fine, but you just need there to be a gap between where you are and the current price of the stock or the crypto. So how do we do that? Okay, so I'm going to look at the Bitcoin chart here, and I'm going to give you an example of a crypto. It's going to be the same for stock. I'm just going to explain the different percentages, and I'm going to give you an example of going up or a bull market and coming down a bear market to show you that they are all the same and it's effective no matter the market. So the what we're going to look at here is Bitcoin. This here is an all-time chart. And what we're going to say with crypto is, technically speaking, a crypto market historically crashes 50 to 80%. In some extreme cases, you'll see around 90%. So you need to know that when you're comparing the market and considering buying the dip. Because you'll see a situation like in the stock market, you can take like a 10, 20, 30 approach. In the crypto market, those numbers are going to be a little different because as of right now, the crypto market is a lot more volatile than the stock market. So in the crypto market, it's going to be 50, 60, or 50, technically 50 to 80, but you can say 50 to 70. And if you're really bullish and you're long term, you can probably even get away with 40%. But I just want to show you these numbers here. If we look at December 17th, 2017, you'll see that the price was $19,114. Now, patience is going to play a big part into this, because if you say, I'm going to buy the dip, and a dip, if you're categorizing it very widely and don't have those specific numbers in place, it's just going to be anything that's in red technically from where you are now. So if you're buying in at 19,114, what would you consider a dip? Is it 16,000? Because you'll know that if historically, now this is 2017, but you'll know that historically, if you have those numbers in place, you'll see those corrections, and they typically start. You can technically, after a bull run or an all-time high, you can normally count on a correction of at least 50%. So if you're buying at 16, which is technically down from the 19,000 all-time high, and if you're long-term, again, you believe in the coin, yes, you still have the opportunity to make money, and obviously you would have with Bitcoin, but that's not you getting the most Bitcoin for your dollars, because technically at the 50 to 80% window, you would know that that window is actually opening up at around $8,000, $9,000. Well, excuse me, that's not 19. So at around $10,000, you would know that that window is actually beginning to open up. So at right here, and around on January 22nd, that window is opening up at around $10,000 to for you to buy in. And again, that window at $10,000 is just the beginning, because historically, you'll see that it would go down an additional 20, 30%. And of course, that stayed true. And it went down, obviously, for around to like around $3,000, and actually didn't test that line again for another 2 years, which is another reason that you need to be strategic with your DCAs. How long are you capable, financially capable of holding? How long are you financially capable, of waiting? Like if it goes down for 2 years, are you in the position? Is there enough meat between your DCA and the price of the stock trending because of your entry point for you to wait 2 years? Are you going to need that money? Because if you're chasing the price of the stock or of the crypto, you can't afford to take money out for 2 years in an 80% correction. You're going to lose 80% of your money. So you have to understand what you're putting at risk and know these numbers so that you're making proper entries in the short term if you know you're going to need the money or if the possibility may present itself. So this is something for you to consider. Now, historically, as I said, the window opens at around 50%, but I do believe because we have an all-time high in retail money coming into the crypto market, and also an all-time high of institutional money coming into the crypto market, I do believe that these percentages are going to condense some, because you'll see here again this second wave, well, really like the fourth, but this last big bull run is still playing out. But you'll see that it the price pretty much went to around 63,000 on this chart, and we corrected down to around 31,000, which is still technically a 50% correction. So I don't know if the chart, we don't have enough data yet to determine if the numbers, if the percentages have changed completely yet. But technically, this would be historically the beginning of the correction window. It may just be 30 to 50% now. But historically, you don't want to entertain anything as far as for in the crypto market as of right now because of the volatility. If it's like, unless it's like 30% or greater, because those opportunities usually present themselves. Now, in the stock market, you'll see that 30% number is going to pop up again, because technically that's going to be the sweet spot. And a long term, even if you want to say, okay, I'm going to do my crypto at 30%, it's a lot better than 5% or 10%, because the goal here again is to have that spread so that you're not always consistently jumping up your DCA. Because if you bought in at $3,000 and then you patiently waited here, and because of FOMO you started buying again at $52,000, and then you're on a bull run, that's not smart investing. Because even though yes, it may appreciate, yes, I believe Bitcoin is going to hit six figures and stuff, etc., but you should know the cycles to know that an opportunity is going to present itself, that when you start having these gap ups, and from institutional, retail, no matter where, you're typically going to have a gap down on the other side of that. So this is why you need to know those numbers and be patient and wait for those entries. Okay, so now I'm going to zoom in here and show you on a 1 day. Let's do a 7 day. And we're going to look at buying the dip here. Because again, technically, buying a dip can be just simply it's dipping down from where you are now. But is that an effective way to move your portfolio? And it's an effective way of investing your money. So you'll see here, we're at around 59,000. Technically speaking, 55,000 is a dip from 58,000. But is that a significant dip that would allow you to put you in a position to have the most options on your crypto and give you the options to take profit? And the answer to that, based off of the cycles of crypto, is no. Now, of course, you can always treat it like an investment account and always put a certain amount of money invested in every month, every week, every paycheck, because you don't really care and you're not taking money out for 10 years. That's fine. But if you're being strategic and you're looking at your entry points and you have a vast portfolio of things, you're going to have to be effective with your entries. You can't blindly put the numbers in. Like if you're narrowing it down and it is an investment account, you're counting on this particular thing, or if it's like an index or something like that, yeah, you can get away with that because you have mass exposure and you have some hedging in there. But when you are doing this and you say, okay, I'm all in on Bitcoin and I'm just going to put money in there blindly, then of course you're going to have the most amount of exposure, A, because you're limited, and B, because you're not picking up the entries at favorable price points. Now let's look at Bitcoin on a all section, and let's try 3 months. So we'll see here. I guess it'll be easier to determine. So, okay, matter of fact, let's do year to date because I like this because it shows some resistance. So, if we look at Bitcoin on a year to date situation, and you say, okay, I bought in at $32,000. This is another way that you can return as far as to analyze entry points, as far as using resistance levels. Now, so you're at around 30,000, 32,000, and you're saying, okay, the stock is, I mean, the crypto is technically increasing in value. What can I still get in? What's a great entry point? And again, you know your numbers and also look at the resistance because technically speaking, if your numbers are accurate, you should be able, if those percentages, the numbers, like the numbers I say, 50%, the window typically opens at 50%. So normally, whether it is a bear market or a bull market, you're still going to see at least that 50% number come up. If that is true and you know that number, you should be able to look for it in the charts and verify it. And we're going to do that right here. So we got a price point around, let's say $30,000, because if we're going to look at the support line going across here, it rallies up and we know the number. We're looking for that 50% window at least. We know that is a good buy before we rally to the all-time high. We don't have to wait for the extreme side of it, but we know that that 50% correction is going to be there. So we'll see an all-time high here. We'll see the high here of 62 before we go into that decline. And again, we have the 49 here, but again, that's not we'll come up and have a little rally to around the 58 range, but that's not a correction from the all-time high. When we start having these gap ups and this consistent momentum, you can expect a serious decline. You're gonna have to look at this and chart when you're looking at Bitcoin and these cryptos. You're gonna have to chart them accordingly. So don't just look at the 1 day, look at the 7 days, look at all of them because a lot of times people, I got into pretty much a debate on one of my videos. People are doing this with Shiba, like they're looking at the 7 day and the 1 year and ignoring the 1 month or the day. You look at all of them and kind of get an idea of the pattern. And this is how it's going to be how you stay in front of it because you can make money on most anything. The question is, where are your entry points and how are you playing it? So we'll look here and you'll see that it comes down again and we test that 30% window, 30% resistance line again. And we'll see, okay, well, this also aligns with that. It's roughly 50% of the high at that time, or pretty much where we peaked. And you come down here, you say, okay, well, this is a point of resistance, and it's also aligning with that figure, that 50% number. This is a great time to buy. This is strength here because technically, if we come down again, I can expect some more resistance here. And it's not like we have a gap up here. We have, because this is pretty much what you want to see. You want to see some ceilings, some floors. You want to see some resistance, some sideways movement. Because I would say if this here was the floor, but this here it was just a straight line. It was just pretty much gapped up. Like a huge celebrity or something like that said that they were endorsing it, and it just pretty much went vertical. Like on a gap up, you can expect the gap down, and that gives the opportunity to pretty much break through this floor. You're certainly at least going to test it again. So what you want to do is make sure that you have pretty much like a little intersection between your numbers that you plan out and also see if you can verify it in the chart. And technically speaking, if you can do that normally, it's usually a safe bet. Now I want to take a look at some stocks in here and show you the formula that I use for here. Technically, this is going to be 10, 20, or 30, with 30 being like the exceptional. I'm really aggressive, but technically anything under 10% from the all-time high, I will not consider. I don't care how red it is. I don't care what the catalyst is. If it's less than 10%, it does not even get considered. So I'm going to take a look at Apple here because I believe that over the long term, Apple is going to do phenomenal and it's going to continue its upward trend. But we're going to take a look here and see if we can find some entry points. So if you're looking at a company, you say, okay, well, I believe you do your homework, you do your evaluations, and you say, okay, I think that Apple is worth, let's say, 130, for example. That's going to be my entry point. So you'll say, as of right now, you would say, okay, at 164.77, I'm going to wait. And that's going to be the pretty much a turning point here as we go into step 3. What we just covered was step 2, which is the 10, 20, 30, and the 40, 50, 60. You got to keep that in mind. That's step 2. As we go over the stock chart, remember that step 3 is going to be patient and you don't have to buy. And that's going to be very important, because if you say that you do the evaluation, you say that, okay, I believe that the company is worth 130 at this present moment. You say 164.77. Should I make an entry? Even though you're bullish, even though you believe that's going to go up, yes, you can still continuously buy every month. Again, if you're saying this is part of my retirement or whatever, I think that in 20 years it's going to be this. Yes, you can absolutely do that. I do that on some plays. But if you say that the evaluation, I'm just using Apple as an example because this obviously doesn't apply to every stock. But if you say that the evaluation is 130, then you simply wait. You wait on that number. You wait on whatever the catalyst may be before you make your entry, because you determine that that is fair evaluation for that company. Now, once you have your entry, and let's say you're at, let's say you got in right here where the number is at $80.01. What you're looking at is at least 10%. 20 is going to be that great middle ground. What you're looking at, 30 or greater for something excellent. Now, with a company like Apple, 30% is going to be on the extreme side. I don't know what would happen. That's something that's going to be more rare for it to happen. But that 10 to 20%, you're going to be looking for those that just going to be like your sweet spot to get in there. And you need to know those numbers and be set and say that, okay, I'm going to consider this a dip for me. For me, this is going to be effective enough for me to get in and give me that meat on the bone, because I know that in this case, Apple is pretty stable. So for Apple, if you're at $80.01 and you're saying, okay, I want to do like around that 20% window, you're looking for roughly $64. Even though if you believe in Apple long term, you're looking at roughly $64. You'll say, okay, at $64, I'm going to make my entry, because this is going to give me 20%. It's going to give me the meat. If I invested lower than 64, okay, I'm averaging up, but it's going to be 20% below the all-time high. It's not putting you right where it is so that you're waiting on another catalyst or another announcement from the company to push yourself up. You're buying below the fair market value of what the company, pretty much, or what the company is worth at that moment. This is the key as far as for increasing your share count, but also doing it, getting the most amount of shares for your dollar. So if at $80.01, you would be waiting until around 64. So you see right here, getting close to 69, and we drop to 57.31. And then we'll have that rally again back up. And that's going to be your sweet spot. And you can tell that if you look at most stocks and stuff like that, you'll start to see, you can tell that most proficient investors, they use a model similar to this, because if you look at most stocks or cryptos, well, mostly stocks, excuse me, you'll see the buying increase at around 20%. So technically trading, day traders and stuff like that, once you see that 20% mark come up, you'll technically start to see like some sell-offs, or that's where you start to see walls and stuff will pop up. But that's a different story. But with stocks, you're going to do this to pretty much have that space there and give you the leverage as far as moving your DC up, but also getting a great amount of coins or stocks for your dollar. So just to recap what I talked about in this video, the 3 steps are going to be, A, you need to consider your DCA and your coin count, share count position. Number 2, know your numbers. Crypto, technically, the window is going to open up at least the 50% mark, historically 50 to 80%. With stocks, you're going to be looking at 10, 20, or 30. Now, you can always, if you want to come up with your own numbers, that's fine. Again, these are my numbers. These are the numbers that I use. So I'm sharing them with you. You're welcome to adopt them. And again, you can technically verify these numbers and see if their patterns changing, because the numbers are always changing. We have a record amount of retail investors coming into the market, as well as institutional money coming in. So these numbers could change over the next 24 months. But as for right now, I'm comfortable using them because we don't have enough data to say that they've changed. But if you are using them, technically speaking, you can kind of do like a cross check or verification of this when you start seeing resistance lines pretty much establish themselves with your numbers that you establish, like your entries. So you should pretty much have like this like meeting of the minds almost, where they cross and you'll say, okay, that's my entry. My preset numbers have played themselves on the chart. They played themselves out historically, and here we are again. We're getting the resistance here again, which is where we determined that it would come based off of our numbers. That's going to be my confirmation inside of the charts. I'm going to make my entry. So when you do that when you pretty much invest this way, it kind of gives you some confidence as far as for just saying that I'm going to buy the dip randomly and a stock is down 2%, and you say, okay, I'm going to buy the dip, and then it dips down an additional 30%. So that's where pretty much that's where those memes come from, where it says buy the dip, and you buy the dip, and it says buy the dip, and it's all the while it's trending downward and downward. That's more so due to lack of strategy and not knowing your numbers and sticking to them. So I hope that you found value in this video. If you found any value in this video, please consider liking it. And or if you know someone who needs help with defining buying the dip and averaging down, averaging up, please show them this video. Like the video, it helps to get out to more people in the community. And if you'd like to get more from me, subscribe. I will be doing a series on this. I post almost every day now. So if you want to hear more from me, consider subscribing, and we will talk in the comment section and the community section. I appreciate all of you. Thank you. And until next time.